Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Thursday, May 31st. Hey, we got a lot of data to go over, so we're just going to jump right into it. But we'll start off with the weekly jobless claims. So last week we had 234,000 people apply for unemployment. The forecast for this week's numbers were supposed to be at 225,000, and it came in at 221,000. So nice little drop, about 13,000 in people applying for unemployment, which is obviously good news. Remember, tomorrow we got the BLS having their job numbers, the Bureau of Labor Statistics, and we do expect another strong jobs report. So be very cautious if you guys are out there with floating, if you're looking to buy or refinance and haven't locked in yet, you may want to be cautious with the jobs report. It could obviously move the market, potentially move the markets here. Now, we'll touch on that a little bit later on, but we'll just move on here. We got the personal income for the month of April. So back in March, it went up 0.2%. Forecast for April is supposed to go up 0.3%, and it came in at expectations at 0.3%. So people are making more money, which is obviously a good sign. However, we got the consumer spending side of things, so people are making more money, and of course, they're spending more money, as we can see here. In March, it went up 0.5%, their spending habit, and it was supposed to go up 0.4 in April, but it even exceeded that, 0.6%. So retail and stuff like that should be looking pretty good in terms of people spending money out there, getting the economy moving. This is what was kind of needed, which we've been lacking for the last, 10, for last decade, basically here. Uh, to move on here, we got the personal consumption expenditure, or PCE. This is the Fed's favorite gauge of inflation here. So there was nothing in March. It was basically no change. But expectations for April is supposed to go 0.2%. It came in rate expectations at 0.2%. This brings us year over year to 2%, which is obviously kind of in line with what the Fed wants. Now, when you strip out food and energy, this is really what the Fed will look at. Is we get what they call the core inflation number here. And this is really the number that the Fed, when they talk about inflation, what they really work with, because we can't control food or energy, the prices, because there's such a variables and goes and fluctuates back and forth, that's not something that could be controlled. So they kind of strip that out and give us what they call the core inflation. So back in March, it was at 0.2%. Now, it was reported last month that it was the year over year was at 1.9, but it was actually revised lower to 1.8%. Now, the forecast for April is 0.1%, but it did go up 0.2%, and it also remains at 1.8%. So the year over year remains at 1.8%, kind of in line, but they'd like to see it go up close to the 2% range here. So again, they do see modest or moderate pace for inflation. They do see it going up there, and they do see it potentially rising, even up, maybe even around the 2.5% range, but it might be temporary and come back down. So they said they would be the risk would be they would watch those fluctuations here, just like they didn't give any knee-jerk reactions last year when it dropped down to 1.3%. They still continue to raise interest rates. However, the next thing here is Chicago PMI. This is the manufacturing numbers in the Chicago region. Very good numbers here, actually, as you can see here. Chicago, about 2 months ago, New York and Philadelphia were kind of affected, but Chicago still kind of stayed in a positive territory and still kept going up. Last reporting back in April is at 57.6, and it jumped all the way up to 62.7. So a pretty hot number there for manufacturing in the Chicago region, which is fantastic news. However, we're not getting as good news here for pending home sales for the month of April. So March was revised slightly higher from 0.5 to 0.6% here, going upwards from month to month. But unfortunately, for April, it dropped 1.3%. And again, this is being kind of attributed to the extremely low inventory levels that we have out there. Again, these are historic lows that we've seen, and this is kind of what's bringing these numbers obscuring. We got a lot of strong demand, as most people would tell you, which is why the home prices are going up there. So when homes are listed for sale, they're not on the market as long, and especially if it's a good property, they're not staying on the market as long. And regardless, but also interest rates have been rising, so that also is probably playing a bit of a factor into it as well. But mostly because of low inventory is the biggest factor. Now let's kind of move on here to the headline news. The stock market is down. It did start off a little mixed. What was it? S&P, I think it was up a little bit, but as the morning kind of continued, it just kind of came down, down, down. Now the big news, of course, this is more headline news, is what's affecting the market today, and it's kind of been a factor all week when you think about the other stuff here. But we'll touch on that in 1 second here. The White House announced today that they're going to go ahead and proceed with the steel and aluminum tariffs on Canada, Mexico, and the EU. Of course, we're expecting retaliation in return. Some American classics that could be affected would be like the motorcycles, like Harley Davidson, and of course the whiskeys and stuff like that being exported. So again, these are the things that could be affected on the American side of things, where they're going to retaliate. That they announced earlier in the year that they're going to retaliate, and how they're going to retaliate. So again, this is some geopolitical news here. The other item here, of course, we got the Italian elections that may be taking place. The current person that's in charge basically wants to try to create, let them form the government. So basically right now they don't really have a government in place. A lot of it's interim, so which is kind of forcing them into an election probably around September timeframe. The person that's in charge right now is looking at trying to allow them to kind of, without having to go to the elections, trying to straighten things out right now. But again, there's a lot of resistance, a lot of anti-establishment resistance, which could, of course, a lot of people aren't in favor of remaining with the EU, especially when they have high debt and stuff. Like Greece was talking at one point pulling out. So a lot of these countries are looking at pulling out from the EU, and these are what part of the factors here. Now we've had all week, as we started the week out with Italian and Spain, government uncertainty, to now we got the tariffs going on. We had North Korea, so it seems like a lot of the geopolitical things have been kind of taking precedence over data that we're seeing from the markets. So again, that could play a factor in tomorrow. But let's jump into the bond market. We're kind of just barely above there. We're kind of more unchanged at 3%, so there's no rate change in pricing here. But one of the things that concerns me is that we did have a crossover on the stochastic calendar here, which is not shown on here, but every time we've had that, it seems to reverse the trend. So we could potentially see a reversal again on this. So it could drop a little bit, and that job numbers could play a part tomorrow into it. So if you are out there, you may want to lock in in case we get the good jobs numbers and we don't have any geopolitical that could mess things up. But again, according to the stochastics, which have been pretty accurate, every time we've had these fluctuations from here and here and here and stuff, we've had a crossover, and which has kind of led to the same result. So it's been pretty accurate. And again, we just had that, and it could reverse course here. How much? It remains to be uncertain. And we do got a pretty strong floor of support now. As we broke this Fibonacci level here, as well as we got a 50-day moving average here. So we got kind of a double floor of support, which could help us out. So it might be very short-lived, and maybe go back the other way. But again, on the near term, you may want to just play safe here. Same thing here for the 10-year. We had the reverse here. We're kind of hovering at the 100-day moving average here. We're down to about 2.83 right now. So again, we're just kind of hovering here at the 100-day moving average. And again, tomorrow could potentially move the markets. All right, so that pretty much wraps everything up. It's been kind of a long one today. I apologize. Usually I try to keep these within 5 minutes, but today we had a lot of data and a lot to kind of cover here. But if you guys want to get more data, come over to Twitter. You can find me at Mike Bjork. I do post throughout the day. We'll look forward to see you guys tomorrow. Remember, tomorrow's jobs day, and have a good one. Take care, and thanks for watching. Bye-bye.